Welcome to the C-Suite series presented by ChannelCheck and Noble Capital Markets. Noble's an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on ChannelCheck. Today's interview features Vince Holding Corporation, NYSE ticker symbol VNCE. This fireside chat features Vince Holding Interim CEO David Stefko and CFO John Szczepanski. They're interviewed by Noble Senior Analyst Michael Kupinksi. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on Vince, all at no cost. And now, here's Michael, David, and John.
Gentlemen, welcome. To our viewers, this will be an introduction to the management and to Vince Holdings. The stock symbol is VNCE. From this video, I hope that you will learn a lot about the investment opportunity at the company. It's a company that I currently follow. I have an outperform rating with a $3 target, which I think could be conservative, especially as this company executes on its growth strategy. And I will give you more information about how to obtain my research later in this broadcast. The format of this presentation will be a fireside chat. But before we get started, let me say that the company may refer to certain forward-looking statements during this presentation, and I ask you to please refer to their recent press releases and SEC filings for further information, which are available on the company's IR site. Without further ado, I'd like to kick off the Q&A by learning a little bit more about the management. David Stefko, the CEO, and John Szczepanski, the CFO, a fellow ski, by the way. It's always nice to introduce a fellow ski. Tell us a little bit about your background and your journey to the C-Suite at Vince, and maybe a little bit about Vince.
Thanks, Michael. Appreciate it. Hi, everybody. Thanks for joining us. For my background, I've been with Vince for a little bit over nine years now. Served most of my capacity as a chief financial officer. During 2020, summer of 2020 through the spring of 2021, I was the interim CEO during that period of time. Went back to the CFO role, retired in the summer of 2023, and joined our board of directors. And then in April of 2024, I came back in as the interim CEO as we do our search for our next leader. Then I'll return back to the board. John?
Thanks, Dave. So I'm John Szczepanski. I'm CFO at Vince Holding here. I'm responsible for the end-to-end finance function, finance, accounting, reporting, and in addition to that, business planning and analysis and the logistics function report into me. I've been with the company for 9 months. Prior to joining the company, I spent over 18 years in various roles across finance, FP&A, logistics, and operations at Ralph Lauren. And so looking forward to bringing that skill set to Vince.
You have a terrific management background, a lot of experience there. I was wondering, David, if you can just talk a little bit about and give us a little overview of the company.
Yep, sure. We have a slide here. We'll put a slide up briefly. Takes us back. The company was founded back in 2002. It was founded as a women's apparel line at the time, sold strictly through wholesale. You can see here in 2007, we added a men's apparel line, and then opened up our first retail location in 2008. In 2010, we launched our e-commerce site, and then to our apparel, we added a shoe license in 2012. And then in 2018, we launched our subscription service, Vince Unfold. It's a rental service of clothing, and then more recently in 2023, we formed a partnership with ABG Vince with Authentic Brands Group, where we own 25% of that ABG Vince entity. Authentic Brands Group owns 75%, and we contributed the intellectual property to the business. And we also have a couple of store and product looks that we put together for you to give you a little more visual of who we are and what we look like. While this is up, we do operate in 48 full-price locations today, 14 outlet locations. Our e-commerce site is vince.com. We do have one store also in London. Michael, back to you.
Okay, great. Thanks, David. I know one thing that you don't get from the slides is the quality of the merchandise. It's a very high-end, high-quality casual clothes in it. And I would encourage you guys to go to Nordstrom's and check out some of the offerings there. Obviously, David, the company is in a much better financial position than it was just a year ago. And I was wondering maybe if you can give investors a little bit of background on Vince's journey and where it stands today from a financial position standpoint.
Sure. So I'll go back to tell the journey. I'll go back to 2019, pre-COVID. 2019 was a very strong performing year for the company. In November of 2019, we completed the acquisition of two brands, Rebecca Taylor and Parker. And then, as we all know, in the spring of 2020, COVID hit. What we decided to do at that time was we continued on a path of relaunching Rebecca Taylor. It was our intention when we had acquired it. So we continued on a path to prepare for its relaunch. We also moved to take share at our wholesale partners as they rationalized the brands that they were going to carry within the store. Vince has always been in a number one or number two position when you look across the major department stores: Nordstrom's, Neiman Marcus, Bloomingdale's, and Saks. And so, we strengthened our relationships and our partnership as they rationalized what they were going to carry in their stores through COVID. Part of that was we made investments in inventory, partially to manage supply chain disruptions, but also to have product availability. Again, as the department stores were moving their inventory levels and making investments, we wanted to be prepared. And so in 2022, the spring of 2022, we relaunched the Rebecca Taylor brand, which unfortunately wasn't a great time to relaunch the brand. We did not see from the department stores. They were still trying to be tight with their inventories, and so we ended up in a over inventoried position. And as we went into 2022, both the relaunch of Rebecca Taylor and that inventory position strained our liquidity. At that time, we became more promotional to move through the inventory. We reduced our marketing investments from managing a spending perspective. And we also began the liquidation of Rebecca Taylor. That process lasted into the early half of 2023. And then in the summer of 2023 is when we entered into the transaction with Authentic Brands Group, where we contributed the intellectual property to a new entity I mentioned, ABG Vince. In return for that contribution, we brought in $76.5 million from Authentic Brands Group. And we also retained a 25% ownership in the future royalties that are earned in ABG Vince. With that, we also signed a long-term license to sell apparel in most of the world, and as I said, share in the royalties. And what Authentic Brand Groups and ABG Vince does is they add licenses to the business. We had already had the shoe license I had mentioned earlier. We had also had a cold weather products, hats, scarves, gloves, which got contributed into ABG Vince. Authentic Brands Group since then has signed new licenses, and we'll be launching in the spring belts and leather goods. And then in the summer, fall, we intend to launch handbags under a new license that was recently signed. So this is the next chapter for Vince. We have the financial ability now to invest back in the business, and that really all starts with the second half of 2024.
Terrific. And I know that tons of companies have gone through COVID and we're having some difficulty, and it seems like you weathered the storm okay. And you touched on the financial flexibility now. I was just wondering how significant, it seems like it is very significant in terms of the opportunities now for the growth of your business. And I was wondering if you could just kind of, what does it mean to have the financial flexibility now?
Yep. Well, one of the things we did with the $76.5 million is we restructured all of our debt. And so we eliminated the term loan that we have. We do have an ABL loan, still on the business, but really it allowed us to start investing back in inventory from a breadth and a depth perspective. Because we were over inventoried and being very promotional, we were being very cautious on the depth of inventory we were buying because we didn't want to generate additional off-price business. And so maybe restricted our ability on what we can do with the wholesale channel, or even in some of our outlets, as we worked our way through the over inventory. So I'm happy to say, starting with the fall season of 2024, we are now back to I'll call it normal inventory buying, where we are buying breadth and we are buying depth and taking levels of risks back in the product. Also, as we've talked about in our recent earning calls, we're leveraging our customer data platform. We had during 2021, we had invested in building a customer data platform. We now have the ability to leverage that and make investments in the data that we have there. So we're investing in marketing, both top of funnel marketing and also brand awareness to drive new customer growth. In addition, we've invested over the last 6 months in customer surveys and research, and happy to say that the early findings are reinforcing that we have a lot of opportunity ahead from a new customer growth perspective, which is what we anticipated because we have been so quiet the last few years. But it gives us the confidence now, to make these further investments.
And Dave, one of the key goals of the company is to improve operating margins. What are the margin goals for the company, and how do you plan to achieve that?
Michael, I'll take that. When we last released earnings for our second quarter, we guided operating margins up 25 to 50 basis points for the year. And really, the way we expect to do it is to improve the way we work and the way we're planning the business and operating the business. By doing that, we expect to be better able to match supply with demand, increase full price sell-through, reduce excess, and ultimately get to a better profitability answer for the company in the short term. And it gives us a runway over time, over a long period of time. And we feel like as we also have opportunities around improvements in product mix as well as in channel mix, as we then pivot back into our DTC business. All of those factors will give us ample runway over the course of the coming years to continue to expand on those margin goals.
So you were talking a little bit about margin improvement, and I know that there's two buckets here. There's revenue initiatives, which you talked a little bit about moving to full price drivers and more disciplined promotions, and then you have these cost initiatives. And I was just wondering if you could just talk a little bit about how you see that margin improvement over the course of the next couple of years, and maybe the shifts in how we are to see that, whether it's going to be coming from revenue initiatives or those cost initiatives. And how do you see those playing out over the next couple of years?
Yes. Last year, we worked with McKinsey to take a real deep dive into our P&L and identify opportunities for long-term growth in sales and profitability. And with that initiative, we set up our own transformation office. With that work, we identified over $30 million of opportunity over the course of 3 years. When we look at the construct of that, we expected about half of that to come from product cost efficiencies. The key mandate, though, was that we were not to impact the quality of the product. That was tantamount. And as you called out earlier, Michael, the product quality is very important to the DNA of this business. The balance of the opportunities that were identified were in the areas of pricing and promotions, as well as operating expense improvement. So it's really looking at the top to bottom of the P&L. Since we rolled this out back almost a year ago in November 2023, we're seeing the initiatives come to light. At the midpoint of the year, this year, we're ahead of plan, ahead of schedule. So we feel really good about the program itself. We feel really good about the ability to achieve these targets. And we have teams working already, pivoting into the future, looking at next year and the year after to ensure that we continue the momentum there.
And I was wondering, because you outlined for us the margin expansion goals for the year, I was wondering, you've given some thoughts about the second half. You're going to be facing some higher royalty payments, and I was wondering how much of your guidance in the second half is derived from the revenue initiatives versus the cost initiatives.
Yeah, Michael, when you look at it, we've really lapsed the non-comp royalty impacts on the P&L in the first half of the year. We closed the ABG transaction in May of 2023, so we really had 4 months of non-comp activity when it comes to the royalty. The back half of the year is more apples to apples when it comes to our royalty impact and footprint on the P&L. What we do have as a headwind is the reset of our short-term incentive compensation plans, which we called out as a headwind in the first half of the year. That will continue, but we feel that we're more than compensating for the royalty expense with everything that we're putting into the transformation efforts.
Yeah, and part of the improving strategy for your improving margins, as you mentioned, will be to decrease the price promotions, which necessarily will mean improving brand awareness. And I was wondering if you could talk a little bit about your plans to increase marketing, and where do you believe that you will receive the biggest bang for your buck?
Yeah, so this year we're focused on re-energizing our customer acquisition efforts and increasing our brand awareness through more top of funnel marketing opportunities. I mean, in addition, we'll continue to better leverage our customer data platform, I mentioned, for insights to enhance and deepen our existing customer relationships and drive further loyalty, while also targeting new customers. And then continue to leverage a healthy mix of marketing channels from direct mail to social media, enhance our messaging and attract, new to brand consumers.
Gotcha. And then in terms of the revenues, you've obviously pivoted back from direct to consumer to wholesale. So you got these two revenue streams. How do you see the trend playing out in the future? Is there a percent of sales that you believe will be derived from wholesale versus your direct to consumer? And then what does that mean in terms of your direct to consumer and e-commerce and the margins going forward?
Yeah, the pivot that you're seeing, Michael, this year is really not driven by a strategic shift at all. It's really a point in time comparison factor. Part of it is in our DTC fleet. During COVID, we were able to take advantage of some opportunistic lease deals for our store footprint, which are now lapsing, and we're looking at the renewal there, and we're being very cautious about the fleet in terms of the profitability. So while we see some pullback in relation to store closures and some renovations of the fleet, we're also seeing that pullback in promotional activity that's also impacting top line. But it's a temporary piece on stores. We expect to course correct over the course of time and invest back into our DTC channel. Long term, we really see both channels as complementary, and we're going to continue to look at take an omni-channel approach here, and really expect to be where the customer is and take advantage of that.
That's terrific. And in terms of, I'm going to move on to this, what I think is an important question. You have an established relationship with Nordstrom's. Do you feel that your distribution with Nordstrom's will preclude you from seeking another high-end retail relationship? And if not, can you just talk a little bit about what you see on the horizon for your distribution with high-end retailers like Nordstrom's?
Yeah, Michael. We've had as you mentioned, we've had a very, very long relationship with Nordstrom's. They're our largest customer. We're very proud of our relationship with them, as well as we are with other key wholesale partners. As I've mentioned earlier, across the majors, we're number one and number two positioned. We continue to work with Nordstrom's on how together, we can further grow the Vince brand within their stores. Wholesale is just over half of our total business today. If you go back when we IPO'd about 10 years ago, we were about an 80% wholesale business. To now we've grown closer to 50-50 from a DTC perspective. Majority of our wholesale business is in the U.S. 82% of our wholesale business is in the U.S. So we do see opportunity to grow internationally. As I mentioned, we sell in the 4 major department stores. We also sell in most of the mid-majors and also have a very robust portfolio of the specialty boutique shops around the country. And where we see the greatest near-term opportunity with our domestic partners is to expand our presence, particularly through growing our men's business, which we expanded in the early fall, late summer within Nordstrom's. We now have men's across all Nordstrom's doors, and so we're now a dual gender brand there. In addition to that, we do see space in mid-major and specialty retailers that have been focused on designer. Designer, as we know, have been raising prices and causing somewhat of an angst from a consumer perspective, and we see more opportunity with those customers, for the high quality luxury products, that we provide at a slightly lower price, as the customers, gravitate to spend their dollars elsewhere.
And one of your growth strategies is to increase your presence through expansion of owned and operated stores in markets not heavily penetrated or you don't have a presence in. For myself, I'd love to see more stores in Florida. So can you talk a little bit about your goals of adding new stores, either domestically or internationally, and maybe give us some insight on where you think your next store opening might be?
Okay. So we believe we have opportunity to grow across the whole entire DTC channel. We believe we have a lot of opportunities from e-commerce perspective too, but recently we have seen outperformance in stores compared to e-commerce. And just, this is from the strides we've made really to enhance our omni-channel capabilities. I mentioned earlier, we launched our customer data platform, in 2021. We also, in 2021 and 2022, upgraded our e-commerce platform, which we believe helps enhance the customer experience and deepen our relationships with our existing customers. And while we know we'll be measured with our store opening strategy, we do look at white space in front of us from opening new stores. But we believe as we open new stores, it's an opportunity to grow our e-commerce business also. The last new markets we entered, which were a few years ago, was Denver and Charlotte. And what we saw in Denver and Charlotte, we went there because we had strong e-commerce business, but what we saw was not only did those stores ramp up faster, we also saw growth in our e-commerce business. So we're certainly looking at new markets today. We are only in 16 of the top 25 retail trade areas in the country. And so we believe we have material opportunity to grow our store count. And you look at markets we are in, you mentioned, Michael, Florida, you talk about Chicago or Houston or Dallas, those are markets we only have one or two stores in. So obviously opportunity for further growth in those markets. And then with respect to international, similar to domestic plans, we're taking a more measured approach. We do see opportunity to expand the brand in both Europe and Asia, and we opportunistically look for opportunities there to add, especially to our one store we have in London, which is performing well.
And gentlemen, that is all that we have time for. I have to tell you that all of my research associates are expecting me to gift them a Vince sweater for Christmas. I have to tell you that. So I would like to thank you, David and John, for joining us today and telling the fascinating story about Vince. And a big thank you to our viewers. To learn more about Vince, the stock symbol is VNCE. I ask you to please visit channelcheck.com. There you will find my research on the company. The stock is currently rated outperform with a $3 price target. The research report will contain important analyst certifications and disclosures. And by the way, the research is free on Channel Check, and the traditional spelling on channel with the check spelled CHEK. Simply add your email address and create your own password. You will find videos, research, and interesting articles on thousands of emerging growth companies just like Vince. Again, I'm Michael Kupinski, the Director of Research at Noble and the analyst that follows Vince. And again, I'd like to thank you for your participation today. Thank you.
Thank you, Michael. Thank you, everybody.
Now, please welcome the mayor of Boca Raton, Florida, Mr. Scott Singer.
We are excited to have so many thought leaders in emerging growth companies join us in our city, one with a history of innovation at its core.
And here we are on the campus of the Florida Atlantic Owls.
You can start a company with a great product and become a multimillionaire.
Well, first of all, I'm thinking of the business. What is it, right? Is it scalable? How will I make a profit?
The world does not be a path to your door. There really is no such thing as a better mousetrap